What's up, everybody? Right before we get into the show here, just want to give a quick shout out for our next Blockworks conference coming up in just over a month. Permissionless 4 is happening June 24th to 26th, and it's a crypto conference all for the developers and builders in the space. We're going to be hosting it right in the heart of Brooklyn, New York, and it's going to be a ton of fun. There's going to be a lot of fantastic speakers, and the whole Forward Guidance crew is going to be there. Myself, Tyler, Quinn, we're going to be doing a live roundup. There's going to be some wicked community events. Come meet us, have a beer with us. Come see some of the awesome side events, some fantastic speakers. There's new ones being announced every single day. So go ahead and get your tickets. Use the code FG10 to get 10% off and don't miss out. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. Visit blockdaemon.com to get started or book a call with their team today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. We are recording here Thursday morning off a pretty tumultuous 12 hours where we got a lot to talk about in terms of the tariff pause that got injuncted by the courts. We'll get into that in a minute. But yeah, what's going on, guys? How's your week been?
Man, I can't believe it's almost June already. The year is just flying by.
Yeah, it literally feels like yesterday where it was like August and we were talking about like the Fed cutting and all that stuff and we were chopping up there, and then, you know, Tyler went on his side quest and just felt like it blacked out for a few months, and here we are back again, almost June.
And nothing happened.
Nothing happened. Yeah.
Nothing happens ever.
Yeah, stocks are flat year to date.
It's probably every career path, but markets, man, it just, I guess that's a downside is like you wake up and it's 5 years later.
Yeah. Quinn, are you on a ship or something? You got a sailor theme going in the background.
Yeah, just some redecoration, you know. I like got to keep the summer theme, so when I can't be out on the water, I can pretend I am.
Yeah.
Oh,
Yeah, you gotta see in the comments if people can guess those knots. I see a double fisherman's, I see a bowline. I don't recognize the rest. We'll see if other people can cover them.
You're such an outdoorsman.
Thanks, man.
Yeah.
I just had to flex there real quick.
I'm from Calgary.
Dude, I'm not even from Calgary. Come on. Okay, before we get into this, Permissionless. It's in a few weeks, just over 3 weeks. End of June. It's gonna be a ton of fun. Brooklyn. We're gonna be there. 3 of us gonna be there, chopping it up live. There's gonna be a Forward Guidance meetup too. We're gonna have some beers. So, you know, go get your tickets. Use the code FG10. You'll get 10% off. Go to the side event page. Go check out the Forward Guidance meetup. We're going to be chopping it up at a bar. It's going to be a ton of fun. So, yeah, don't miss out. We got new speakers being announced every day. I think there's a few more other surprises that are going to be coming down the pike. But, yeah, don't blow it. It's going to be sick.
I think everyone just wants to know if Tyler's going to be there, if he's going to bail. Like,
yeah, we'll see if Tyler actually shows up.
Everyone was just like crying because
there's like a 97% chance. You know, I got to say this. So I grew up in North Jersey, and Brooklyn, when I was growing up, was like, oh God, Brooklyn's terrible. And now I got to say, I've never really been to Brooklyn, sadly, besides like growing up like an hour away maybe. And I don't know. I'm kind of excited to check it out because I've heard it's very nice. Like Mike lives there now. You know.
Yeah, I've heard all the cool kids live there these days.
Yeah.
Brooklyn's the spot.
All right, yeah, get your tickets. It's gonna be a ton of fun. Don't miss out. All right, let's get into the meat of things. Big news. Federal court ruled President Trump didn't have authority to impose sweeping tariffs on virtually every nation, avoiding the levies that have sparked a global trade war. So lots to unpack here. We're going to do our best to try to LARP as legal professionals in the international trade space, but we're probably going to do a terrible job at it. But we'll try to navigate it anyway a little bit, just to try to understand how to think about things from here on out. So pretty interesting price action based off this. So we'll get into some of the specifics here. I have a few slides and some points to just unpack and get us all up on the same page. But yeah, off the headline, when this injunction came through, ES futures started ripping. We're up like almost 2%, and it's interesting to see that we faded a lot of that move since, and we can get into the reaction function of that there in a minute. But yeah, so it's important to discern the two routes that have been taken so far for implementing tariffs. There's the IEEPA route, which is related to this idea of national security purposes, and that's where a lot of the tariffs have been put through in terms of the reciprocal ones, the ones related to the fentanyl crisis, et cetera, et cetera. So you can see if you just look at this chart. So there's also the other side of things, which is like the Section 301, which has been the big driver of tariff implementation against China. This is what was largely used in the 2019 China trade war during Trump's first term. And so you have to piece apart the two different aspects here and look into that. And overall, some interesting analysis that I've seen so far is that, roughly speaking, that takes us, if it actually holds, and we'll get into this, from roughly like a 10%-ish effective tariff rate down to something like 3.5 or something like that. So obviously, the second order effects here is there's a lot of different routes to pursue to actually see if this holds or not. And pretty quickly off the bat, we've seen that the Trump administration has appealed it. It's going to go straight to the Court of Appeals, and then if they deny that further, it'll get elevated to the Supreme Court. I already saw a headline this morning that the U.S. is planning to bring this to the Supreme Court by Friday. But overall, from my understanding of things, there's a few different routes they can take. They can try to get an emergency stay on it, which would allow them to re-implement them pretty much instantly in the next couple of weeks. But through this appeals process, there's obviously a few different routes they can take to go through the motions and to do so in an expedited fashion. But even then, through like the expedited route of this appeals process, it would be like a few months approach. So it seems like we're at this juncture where we've traded this dialing back of tariffs for this increase in trade uncertainty again. It feels like almost all cards are on the table. This is just a quick chart that I saw of just like, I don't want to get into the nit and grit of this, but just to show that there's a lot of wonky legal, I don't want to say loopholes, but routes to pursue in terms of these random sections of various trade acts, et cetera. All of them are, from my understanding, somewhat limited in their capacity. Like, for example, the what do we have here? Yeah, so the Trade Act, the Section 122, you can see that there's a limit of up to 15% on imports. So you can't be throwing the 100% type of tariffs against China under that, and it's for only up to 150 days. So regardless, it feels like most of these different routes to pursue are definitely dampened versus where we were at a few weeks ago on Liberation Day. So yeah, man, that's the state of play. I want to get you guys' reaction, especially the market reaction too, because it's interesting that the first move was just an absolute rip in U.S. equities. Bitcoin didn't follow, which was interesting, and now we've given it a lot back. And we have the Trump admin coming up pretty strongly right off the bat. They're already on the morning shows, the news shows, talking about repealing it. So yeah, uncertainty is back. How are you guys dealing with it?
I guess the question I would ask is like, I want the best pitch as to why things have even changed. Like, I saw, some sentiment that like, oh, this is the end of tariffs, and Trump's got shot, thrown in jail, and battle courts like for the last 10 years. I don't know if this is going to stop what they want to do on policy. So I kind of I view the move as positioning related. Maybe people were short and expecting weakness on the month-end rebalance and then squeezed after hours. It's tough. We've had so many of these non-US hour moves in both directions, retrace, go the opposite way, that I don't even, it's hard to read so much into those anymore. And then the other thing I'd just add is global equity markets aren't really trading like it's this huge boon. I think China, last time I checked, like China, Japan lower. I think Europe to China lower, maybe Japan's flat or something. So like, I don't know if it really changes much. And then obviously things are muddied because we got some weak growth data today. So it's tough to read into it, but I don't think anything's really changed, to be honest.
I'm so with that. Normally we disagree, but here I feel like positioning is basically just flat. We've had a month of ripping higher. Systematic guys had to chase as the VIX dropped. CTAs had to relever back up, and hedge funds had to cover all their shorts. So we're kind of in this place where all this stuff has happened in the past like month or two, and we're right back to flattish. So I don't know. I guess you have to wait for the incremental cards. But on the plus side, NVIDIA earnings were good. They were behind us. That's a big catalyst for the market. And I don't know. You're heading into seasonally low volatility period during the summertime. But we'll see what happens. Everyone says sell in May and go away. And we have about 20 billion in month end flows here, where Goldman thinks 20 billion has to be for sale in equities the next 2 days and into month end. So we get a little weakness, given global financial conditions have gotten a lot easier. But I don't know, largely if you step back, we're still in the Ponzi. Things are still relatively good. There's no real big blowups anywhere. And I don't know. I think that's my baseline for the next 6 months.
If you're building anything in crypto or institutional finance, you need to know about Blockdaemon. They've been powering blockchain infrastructure since 2017 and are now securing over $100 billion in digital assets for more than 400 institutions. From institutional staking and node infrastructure to MPC wallets and APIs, Blockdaemon is the go-to partner for performance, scale, and security. Learn more at blockdaemon.com. This episode is sponsored by Arkham, a crypto exchange and analytics platform that lets traders and investors review on-chain data, then take action in the markets. With Arkham Intel, you can see what top traders are buying and selling, and then trade directly on that information through Arkham Exchange. Arkham was built to make blockchains human-readable, simplifying data into meaningful insights for the average crypto user. To start using on-chain data as your edge, go to arkham.com. Today's episode is sponsored by Echo Protocol, the leading Bitcoin liquid restaking and yield layer on the Move VM. Echo is already the number 2 protocol on Aptos, securing nearly half the network's bridged assets with over $200 million in ABTC minted. They're unlocking new layers of utility for Bitcoin by allowing you to bridge your Bitcoin or BTC liquid staking assets and earn yield on Echo land. You can also stake Aptos for liquid restaking rewards like EAPT. Backed by names like Spartan, Maelstrom, Selene, and Aptos Labs, Echo is where Bitcoin meets next-gen DeFi. Visit echoprotocol.xyz to explore staking, lending, and bridging. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. I think it'll be an interesting revealing process of how committed Trump and his team are to tariffs, because if he did want an off-ramp, he's been given one in terms of he can just blame the radical left and the judiciary branch for overriding his policies. So I have no idea in terms of the validity of this, but if they wanted to off-ramp out of this and, go off and focus more so on, bank deregulation and getting the big, beautiful bill passed and just sort of move forward from this whole process, there is a pretty golden off-ramp here for him to be able to, basically blame somebody else and be off-ramp. So I still sort of doubt that. I'm more in the camp with you guys that it's more likely that they will fight this, but it is an interesting thing to incorporate into your probabilistic scenarios that if they were looking for an off ramp, they do have one right here. But I'm still somewhat doubtful. I don't know about you guys.
It's interesting, I think, how much sentiment has changed from where we were, because tariffs are something he's been talking about since, for a very, very long time.
Literally ever. Yeah.
And particularly since the campaign trail for this election period. So it feels like we're almost back to like Jan Feb, where no one, people, he had this rhetoric about things that were maybe market unfriendly, and then no one believed him. And then obviously went through in Liberation Day and all these things. And we're kind of back at that spot where, all right, I guess, the taco thing where Trump always chickens out. And then now everybody's first reaction was, oh, great, this is Trump's off-ramp. But I just feel like I don't really know if it changes anything, because what I was trying to game out was, does it change any of the foreign counterparties like willingness or speed to negotiations? I also think like it's not, I don't know. I find a hard time saying like bearish case where they like hold out and say, okay, we're not going to negotiate anymore, because they also don't want to piss them off. So like, I don't think much changed.
Yeah, you had the Japan prime minister come out this morning and start to talk. He said that he had a 25-minute call with Trump today. So I think that's pretty indicative that, yeah, there's still some things going on. But yeah, overall, I feel like the framework that it feels like we're back in this like February situation is correct, where I do agree it's irresponsible to fully discount this idea that tariffs are gone forever. But the other side of that equation is now we have higher uncertainty again for business decisions. You know, we've had, to your point, Quinn, we got some pretty weak economic data today. We had, I think I saw a pretty big miss in corporate profits, a huge miss in pending home sales. We had continuing claims that hit a new cycle high. So, you know, the labor market is still slowly grinding in terms of the direction of deterioration. There is some positive aspects of the economy. Like I still think I'm in the mostly fine camp. Something I really like to always look at is the daily Treasury statement. You can look at like federal employment tax receipts. And this is some of the most like high frequency data you can get in terms of just the state of the economy. And it's still growing. And for those that don't really like numbers and tables, this is just sort of like a visual representation of that as well. And you can see like we're tracking pretty nicely above the 2024 levels. So things are mostly okay, but there are some fractures, and it really ties back to the situation we talked about a few weeks ago when the FOMC meeting happened about just this doldrums that we're in and how that could increase tail risks, I feel like, to the downside in terms of economic deterioration. So it's like it's okay now, but this amount of uncertainty for this long, and it looks like that uncertainty is going to accelerate now. It's just it's a tough place to be for business decision makers, you know?
Yeah, but it's a great place to be if you're a policymaker, because all you have to do is come up with a new acronym and bail the market out. That's all you got to do. It's just the name of the game. Remember that, because all the uncertainty is like you get one headline. Oh, there's going to be no tax on this. Boom, things go wild again. What's so fascinating to me is the amount of energy that's put into analyzing. If tariffs go from 3% to 5%, then the sensitivity on the earnings are going to go down by 6 basis points. And all these guys, like they love crunching these numbers, and then like in a tweet, it's just gone. Like the amount of man hours put in, but they will not analyze the reaction function of the market structure. Dollar in goes 40% of it goes right to the fangs, and that just keeps happening until you have a credit event or an oil shock. And like no one wants to talk about that ad nauseum. It's just like that's really how money works. It comes in. It's a flow-based system. We're not living in an actively managed world like we used to. And therein lies the centralized control of politicians, because they know that money is just going to keep coming in systematically no matter what, especially if they do flip the political switch, positive.
Yeah, that's why I find like the idea of looking at high valuations I think when you get a catalyst, it can be an accelerant to the downside, but on the upside, it's just like, yeah, do you really think that those passive flows are looking at PE multiples or CAPE ratios? It's just like, oh, buy today, buy the fangs because it's market cap weighted, and here we go.
You guys will love this. I got to plug this a little bit. So a couple of my buddies in Austin run a fund. It's generally, I won't name it, but they are, a good activist short selling fund, and they've basically internally created a fund that follows flows, because they're like, there's something wrong. There's no short sellers left in the market, right? Which is horrible, because they're usually the police. They're the police where the SEC has not been involved. And so what they follow with this internal fund is basically how every dollar gets allocated in these passive systematic flows and how to optimize it. And it's absolutely crushing. Like, I can't, the performance isn't, released publicly, obviously, but like that is the smartest thing I've heard in 15 years is actually figuring out how the mechanism of inflows works and how to front run that and hack that system, because that it's like the stuff Mike Green talks about. This is way more important than valuations. And we can all concentrate on NVIDIA, and obviously over the long period of time, earnings matters, but it's really how we structured the pension system and the 401k system right now matters way more than any of these headlines. And now I'll get off my soapbox, but
the Russell 2000 index creators should just throw FANG in there, and then they got themselves a much better index.
Yeah, right. It's crazy.
I think to your point, Tyler, about how the acronym factory will always come guns blazing eventually is pretty interesting, because so last week we talked about Japan, the Japan situation. So obviously the theme of the situation has been that, the BOJ is doing QT at the same time that we've seen insurers that are unhedged and et cetera, and that whole thing start to struggle on the long end as well. And now what we're seeing is the acronym factory, the Yellen playbook is going global. So what happened is a few days ago, the Japan Ministry of Finance, so the Treasury of Japan, talked about tweaking composition of its bond issuance plan that could involve trimming issuance with super long debt and then tilting towards bills. And it's interesting because you see the same headline come from the United Kingdom, which talks about that their focus on shorter term borrowing as fiscal pressure mounts. So, this is my, I think, like, it's been called activist treasury issuance, I guess, ATI, and some argue it to be like a version of QE, where as opposed to just taking duration out, which is QE, this is just taking it out from the auction. And yeah, you got the puppets playing it around, and here we are. Every country is running this banana republic approach. Tilted all the bills. Everybody loves short duration. Nobody wants long.
I love how none of them talk about fixing the actual problem. It's like,
it's just like,
wow, the bond yields are going crazy. I think we should fix it. I got the perfect solution.
Yeah, let's lower front end rates and issue all in the front.
Let's just Ponzify it further.
And that's coming here. It's coming here. This is why the short bond trade is so hard, because you're basically on the opposite side of the trade as politicians that will do anything to mess it up. So if you're short 30-year, it sounds great. It looks great. I feel like you should make money on that. But with one headline, bam, you're toast. Because like they could say, I'm issuing all 5-year and under debt, and by the way, we're lowering rates to 1% tomorrow to finance the government, and it's off to the.
And then you could have the turbocharged version, which is issue bills to buy long bonds, which is probably that's like an operation twist from the fiscal side of things, which is just fucking crazy to me.
I mean, it's all
doing that.
No one, but I feel like that's the next step here.
Felix, see, this is second derivative thinking. You just plugged something that one of the policymakers are going to use, because everyone is always like, oh, what are they going to do? The big spending bill is going to increase the deficit. I can't believe the government. The government's going to be screwed, and there's going to be a big catastrophe. It's like, we all know that. Everybody knows that. The amount of work that's been done on that, everybody knows it. Just buy Bitcoin and shut up.
I think Japan's, they're all interesting because, Japan and UK now are, UK just passed China, I think, is the largest holder of our debt, if I saw that.
Yeah.
Inflation in Japan is the worst in developed nations. So, last week we showed the price of rice and food and housing is problematic. And, at some point, you do enough of the Ponzi, and for a country that imports everything, they're short energy, all these kind of core imports, and really exposed to prices. It's going to matter. It's just like I think it's hard to get that right, but clearly they don't care yet. I mean, Japan's inflation rate is above 3%, and their short-term BOJ rate is at half. a percent.
Yeah, you know,
So,
you know what they end up doing, and this is like they end up repatriating capital and strengthen the yen so that they can purchase those goods with a stronger yen. And therein lies like that's the shrinking, you know, globalized capital market system. And I can't wrap my head around. I think they would rather get together and say, we're all going to do QE together and slowly devalue fiat until nobody realizes it. That's probably the more likely outcome than Japan selling, you know, all their bonds here and causing a credit crisis in the US.
That's the game for years, but now with inflation in different, like that's the capping factor. And because it becomes a social decision, right? Like you can do that, but obviously it increases inflation and then you risk, you know, civil upheaval.
Let's go to a thought game because I keep battling this. Like this global capital flow thing makes me like so bearish that like I'm bullish, right? But at the same time, I listened to Eric Schmidt on a TED Talk. I think it was like posted a week or two ago, and I'm just going to read what he said. He goes, the key thing to understand about this new economics is that we collectively as a society are not having enough humans. Look at the reproduction rate in Asia. It's essentially 1 or 2 parents. This isn't good, right? So the rest of our lives, the key problem is going to get to people who are productive. That is, in their productive period of their lives, more productive to support old people like me, right? Who will be bitching that we want more stuff from the younger people. That's how it's going to work. These tools will radically increase that productivity. He's talking about AI. There's a study that says we will, under the set of assumptions around agentic AI and discovery in the scale that I'm describing, that there's a lot of assumptions that you'll end up with something like 30% increase in productivity per year. Having now talked to a bunch of economists, they have no models for that, what that kind of looks like. And so I keep going back and forth between this, if AI works, and we have a 30% productivity boom, like you can kind of work your way out of all this crap, and it's going to just be a massive like bull market in whatever. Like valuations just go absolutely bonkers, I think. But then so I hear like the inflationary scare, but then I hear stuff like this from a guy who built one of the most powerful companies of the last in the world ever. And it's kind of hard to like hold those two things in your brain and know that like those can be two separate outcomes because they're so polarizing. It's ridiculous.
well, I think this gets to the problems of what the Trump admin's trying to, or at the beginning was trying to fix. I mean, I guess it's unclear because they're pivoting on some items, but you just mentioned, you know, a very deflationary force. But when you look at the CPI problems in Japan, it's food, housing, shelter, energy, electricity, and, you know, some other things. So we can have that, but also like if they're the low, it just expands this, you know, this consistent save by the Ponzi-nomic centralized governments just continuously exacerbate this wealth gap until it becomes worse and worse.
We're all just going to be selling our OnlyFans. Like subscribe to my OnlyFans, by the way. Because that's where
Literally, it's like OnlyFans and hyper gambling on chain. Like it's
like
okay, but check this out. Like then you have the Anthropic CEO talking about how you could see unemployment rise to 20% from white collar jobs. Like this headline hit this week too. I think it's so important, to consider just how wide the outcome possibilities are at this juncture. Like we have no fucking idea. To your point, like you got to balance these ideas, but.
Dude, and McKinsey just let go of 10% of their workforce. Like Booz, like there's Booz Allen, all these companies that like really don't do anything but consult. And they're like multi-billion-dollar companies. They're just toast. They're absolute toast. And so like I can't. I'm battling. The imbalances are just going to be epic. And I think the hedge is gold and Bitcoin. You know, you have to have it in your portfolio no matter what. And I don't think boomers have added it up, but our generation totally has. But it's incredible. Like, have you done the deep work? Like the 15-minute like research report can do what like a team of McKinsey people could do over a week. It does it in like 15 minutes.
It is amazing. I mean, you got to be using it. It reminds me of crypto in you know, years ago when you start using it and you understand financial services and okay, I'm lending, I'm borrowing, you don't really know what you're doing. You're clicking on wallets, you're playing around with protocols, and then after a year or two, you're like, wow, I just taught myself a whole new industry and asset class. And I mean, it's not really all new, but just technology. So that's how I think AI and how you just got to be incorporated. But if we have any listeners in Japan or close to the BOJ or the economy and political situation, I'd be curious because inflation is much worse of a problem from just like the numbers perspective over there than here. So presumably, you would expect, I personally would say, like, if we still had 3.4 inflation and the Fed was holding rates at, this real rate differential, our currency's plummeting, and we have this inflation problem. Politically, we know, I think the West has learned, like Europe and US, through this populism movement, that inflation is the number one killer to your political reelection dreams. Like populism movements, I mean, you can, I think, boil a lot of this stuff down to inflation, and it's probably why Biden lost reelection in many ways. But so I guess it makes sense given where they're coming from, and it's just what they've done. But at some point, it feels like to me that, okay, just continuously easing, the currency is going to pay the price, like inflation is going to pay the price. Like eventually it seems like that sort of populism is going to influence and they're going to have to do something, but maybe not, maybe because it's the bedrock of the global carry trade. And so I guess in a way, Japan doing that allows, everybody else to be easier too.
Yeah, it's like the fight basically between, like, you have one side, which is the financial repression side of things, trying to keep it capped, versus like the populism upheaval, which is like, holy shit, the price of rice has doubled in the last 2 years. Like, this is not sustainable for my just basic living standards. And yeah, that's what I feel like is the great battle of the next 10 years in basically every country.
We're seeing in real time how hard it is to effectuate the change. I mean, this is like that it's needed to actually fix it. So that's where
Congress people like to spend. We know that. This episode's sponsor is Blockdaemon. It's the gateway to the decentralized economy. If you're serious about crypto infrastructure, Blockdaemon is the partner trusted by top-tier financial institutions and the biggest names in Web3. They're the number one institutional staking provider by volume, managing over 250,000 nodes globally with over 70 points of presence. Their ISO 27001 certification and slashing risk protection means your assets and operations are backed by audited security standards and 24/7 monitoring. Whether you need secure notes, MPC wallets, or staking at scale, Blockdaemon delivers enterprise-grade reliability and peace of mind. Visit blockdaemon.com to get started or book a call with their team today. Meet Arkham, the world's first crypto exchange powered by crypto intelligence. Arkham allows you to review on-chain data, see what the top traders are doing, and then act on that information with Arkham Exchange. They've made blockchain data human readable with features like profilers, visualizers, and custom dashboards, making it useful and actionable for everyday crypto users. Arkham believes that transaction analysis, the study of wallet activity and fund flows, will match or even eclipse traditional technical and fundamental analysis. And in a cycle full of hacks, rugs, and scam bundled launches, the best protection is knowing who's moving funds and where they're going. That's crypto intelligence, and that's what powers Arkham. Head to Arkham.com to start tracking wallets, following flows, and trading with an edge. Let's take a moment to talk about Echo Protocol, one of the fastest growing DeFi platforms on Aptos. Echo is pioneering Bitcoin, liquid staking, and restaking in the Move ecosystem with over $260 million in TVL and deep traction across DeFi protocols. Here's how it works. Bridge your Bitcoin or Bitcoin liquid staking tokens into the Echo ecosystem, mint a BTC, Echo's yield-generating BTC primitive, use a BTC in EchoLend to maximize returns, or stake Aptos to mint EAPT, giving you exposure to liquid restaking opportunities across the Move VM. With a mission to unlock the full potential of Bitcoin, Echo is quickly becoming a cornerstone of the Move-based DeFi world. Check out echoprotocol.xyz and start earning with your Bitcoin today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Can I go down Bearsville for a second?
Yeah.
Yeah.
I mean, All right. So hit me with slide 38. And this kind of says it all, but it's a tale of two cities. This is the credit card delinquency chart, the percentage of credit card debt that's 90 days or more past due. And you're basically at 2008 type levels for the poorest section of households. And, it's clearly rising. And then this one on the right is really fascinating to me. Real disposable personal income in the blue line versus the real personal consumption expenditures in the red line. So you're seeing, this is negative real wages, where this is where people start really getting pissed because, the costs are going up relative to their incomes. And so like, there's clearly part of I think if you're not in the innovative AI productivity software world, like you're probably getting left behind in a lot of senses. You're not getting the wage increases, et cetera. And that's what happens when you have a centralized economy. So you're in a relief valve. You got to find the relief valve, right? If you're in those buckets, which is,
and I feel like for now it's been the savings rate, but that's hitting lows now. Like they've been able to manage this because saving rates were pretty high after COVID, but now
yes,
they're way lower.
Way lower. And then here's another one that's kind of, it's got me. This is where I think a policy decision is coming sooner than we think on the rate side. All right. So this is the limited part. Yeah. So this is kind of interesting. It's from the information. Basically, here's a quote from the information article. It says it's about how endowments want to sell their VC portfolio because they're not getting, money back from it, years in. It says these institutional and wealthy individuals are looking to sell their funds stakes as cash distributions, usually generated when a startup goes public or sells to another company, having fallen to historic lows. That makes it hard for endowments to meet their own distribution needs, such as assisting with tuition and funding research, and for pensions to make payments to their members. Bill Coker, CIO of a family office of the San Francisco Employees Retirement System, said 5 out of 7 VC funds he met with this year have low to zero DPI, which is distributed to paid in capital ratio, which means the cash VC firms have returned to investors. So basically, they're not getting any money back, and now valuations in the private sector are getting cut. And so you have, the poorest section of the economy is getting dinged on credit cards. They're getting eaten up on inflation relative to their wages. And then endowments are, because, Trump's kind of going after college endowments in a lot of senses, and they're trying to raise money for their institutions. Now they become net sellers of private assets. And the system's kind of like shrinking in a way, and you have to bail it out because if you don't have the liquidity here, it's going to be a self-reinforcing cycle. And that's why we watch credit spreads so much.
Yeah.
But
well, I want to ask that about Tyler, because you always bring up credit spreads, but I've seen this interesting criticism of credit spreads because, all the high yield stuff that is public is okay, but all the junk is hiding in private.
yeah,
And that does not get considered into high yield credit spreads publicly. So yeah, do you feel like the canary in the coal mine is in this crap?
Yeah, I mean, like the article goes on to say some of these funds, some sold at a discount of more than 50% of their value. So you're basically everything got marked up. But if you think about it, like you have to have, there's zero IPO market right now. You have to have innovation and exits in the public market for the whole system to work, and you're not. It's basically getting self-reinforced to the fangs, and that's why the market really doesn't go down, and a variety of other areas. It's just massively centralized, but like there's pockets of the market that are sucking. And if you don't have, like, this is really important to our system because a lot of money has gone to the private markets, and this is the innovative engine. And so if you have everyone turning net sellers, like, cool, there's a lot of zombie companies out there, and it's really, it's kind of scary.
I mean, can you blame them if all these VCs are just the best ideas they have is funding the next scam grift crypto treasury company? I mean, like,
oh, dude,
it's like literally what crypto VCs have resorted to. Like,
Wait. Let me actually say, I think
God,
Wait. I know there's a lot of weird crypto projects out there, but this is going to like overvalued private companies that like some sociopath raised real equity from. I at least think the money from here, now that you have the administration literally behind crypto, all they want liquid private VC where you can actually get out of it. I think that's where the next big boom is going to be, because they're like, oh shit, I took my hickey on, private equity and I had to sell it down 50%. I need something. Liquid token funds are probably going to be like a big thing here, because you can at least get out, and the administration wants it's behind it now. Like Trump's doing convertible bonds to buy, crypto now. It's so you have that backing. And JD Vance just said on the other day, he goes, Bitcoin is the way out for the, elite controlled system. Like the vice president just said that. So I don't know. Maybe I'm
no, you're right. The issue is that this is just the time old tradition in crypto, is that we just take a good idea and just like extrapolate it into like look at this, Tyler. You got Vivo Power has raised 121 million to launch an XRP focused treasury strategy led by Saudi prince. Like this is just magic.
I don't even know what that means, but
we got MicroStrategy for XRP funded by the Saudis. It's just like, it feels like you just have a hat with a bunch of random words in it, and you're like XRP, Saudi, MicroStrategy.
Yeah, that does make me nervous. If treasury bonds weren't, such a bad deal right now, this would make me way more nervous. Like I think people were in just unknown territory of where the hell to put your money.
Yeah.
And so they're placing bets on all different sectors.
But no, I do think you're right. Like the direction isn't that way. It's just the issue with crypto industry and these, like, it's just we take it to the extremes every single time. And like this is going to be the leverage blow up on the other side of the other end of the cycle, just because we take things too far every single time.
Yeah, you know what though? We've never had a 2000 for Gen Z and millennials. We've never had a bubble like 2000 or 2008 for their real wealth accumulation generating bubble that you could buy anything like pets.com and it went up 100%. Like that happened a little bit, I think, in 2017 and like 2021 a little bit too. And so, but like not where, you make like shit tons of money. And I think that's where this all ends, is that's the boomers the boomer system does not work if they can't sell their houses to the next generation, and you need to make up that gap somehow. And so that's the whole name of the game to me.
Speaking of housing, I don't know if we have any slides on that, but the pending home sales was a disaster. And you have economic. I find it interesting that that's obviously a delayed data point, and rates are now higher than where they were even a month, 2 months ago. I think the housing market is teetering hard here, and I mean, historically, it's been a very big driver of economic growth and activity.
Yeah, I totally agree. I saw a headline, I think it was Redfin posted it, that there's something like, I don't know, 50% more sellers and buyers at this juncture or something like that came out today. And yeah, man, I think the real estate situation is super hairy. I think it's actually way hairier in Canada here too. So obviously we've talked about this before, but here in Canada, every mortgage gets reset at every 5 years. There's no 30-year fix at, you can't have the boomers sit on like a 2.5% 30-year fixed and just, even if the Fed jacks rates to 10%, they're just sitting pretty. Here, everything gets reset every 5 years, no matter what you have. So we're entering this situation now where you have this huge refinancing wall coming up here in Canada, because everybody that was buying their houses and refinancing the mortgages in the post-COVID ZIRP 2021, that's coming up the 5 years this fall, and so you have that.
Get ready for some acronyms.
Get ready for oh man, but I think there's some pain coming first, at least in Canada. I don't have as good of a reading in the US, but I think it's going to get really dicey in countries like this where you have everything resetting, because all of those mortgages, why would they have refinanced anytime until the very last second, right? So now the rates are going to at least double, and you do that into a market with huge amounts of inventory. I think things are going to get kind of squirrely here.
Yeah, it's right when all the stuff is coming online that was built in 2020, 2021 to facilitate all of this activity. I mean, in the US, it's interesting too, because there's this FHA foreclosed, defaulted loan program that's ending later this year that basically has been bailing out there's about 7 million FHA loans, mortgage loans, average size like 215K, and about 1 million of them are late and some sort of forbearance. And basically a Biden era COVID program was similar to the student loans, just allowing that interest to be missed, and everything's dandy. So there's a lot of problems on that front as well. And the affordability is I think is just, even though everybody's locked in to, these cheap mortgages, like the supply just keeps adding up, and eventually, people are going to have to transact. And I think that's a pretty big sign. If sales are if there's like more sellers than buyers enough to push prices down, despite where rates are, that's telling you that people are leaving their average like 4% mortgage to move because they have to, when mortgage rates are at 7%, and they're getting squeezed across these other sectors, as you pointed out, Tyler. It's dicey, I think.
Yeah. I listened to some weird podcast, and it was about the $100 trillion wealth transfer from boomers to Gen Z and millennials. And he basically said the reason why this isn't unraveling is because so many people are just secretly getting money passed down to them and to buy houses. And so like their parents are putting down payments on it.
The boomers.
So like there's a whole underground economy here that's keeping shit together, that if you actually let it work, I think it would just be toast. But
the problem is that rate cuts don't fix this, because rate cuts, I think if you cut rates now, the long end rises again, just like September.
No, you know what they'll do? They'll just, they'll lower rates, and then they just won't ever issue on the long end. They'll just keep it. So the long end will come down, and they'll like Felix said, they'll just issue on the front end and buy the long end. It's just,
yeah. Here's something I want to throw in that just hit the tape. I want to throw you guys, but we just got news that Jay Powell finally met with Trump. So I'm just going to read this out. Did not discuss monetary policy expectations with Trump. Powell stressed path of policy will depend entirely on economic information. Powell and Trump discussed growth, employment, and inflation. So they finally met. They haven't met yet this term. And I bring that up because it's interesting timing, because I feel like the game is, yes, the boys got to put their differences aside and come together to manage this Ponzi.
Yeah, that's it.
I mean, you know what that is? That's best at saying, Donnie, you got to shut the fuck up on the Twitter and just meet with him, because you're not getting any goodwill blabbering. And so here we are, and we'll see if it moves the needle.
But doesn't the Treasury is now paying more in interest expense than, their military budget? And Neil Ferguson says that's the downfall of the civilization. And so if you're Besant and you basically go, I think you have to work hand in hand, like Yellen and what's his name had
you do
breakfast every day. And
Mnuchin?
Yeah, and they figured out how to finance the government. And I think
President Powell have lunch every week.
Here's my end thing on the AI boom is, after reading that situational awareness paper by Leopold Ashbrenner, I don't know if anyone read it, but I think it's more right than wrong. For what my opinion is worth, it feels very right to me, which is like in 3 to 5 years, once we hit 90 gigawatts of power, like AGI is going to do all this stuff. And he makes a point in the paper about this is a military technology that we have to win at in America. And so you can't have a recession. We're in a space race now. It's why, like I say, you have to buy AI infrastructure companies. You have to buy, because if you can't have a credit crisis and have your economy implode when there's this giant boogeyman 3 to 5 years out that can literally like completely surpass you with AI. So I think that you have to keep that in the back of your head, that the government policy wants to create innovation in specific military domains, AI, space, which is why
What about nuclear? We got an exec order on that
Yes.
this week.
Yes.
Tell me about the nuclear, Tyler. Come on.
I'm starting an ETF, and it's got all this stuff in it. If you want, just call me up. I'll get you the package, give you a good price.
1%
Good
management
price.
You have to play these themes, because if you don't, like, I mean, it's so in line with all the generational change and military change. But like, yeah, nuclear is a huge one. You need to power the AI. China's beating us on the power. This is all the all-in podcast guys are tooting their own horns on this stuff because they probably own all the infrastructure companies. But
Yeah, they love the smell of their own farts more than we do.
yeah. You know what? But so like all these things, I got to plug Rocket Labs and Intuitive Machines because they're the only public proxies. And that you got to play space, you got to play nuclear, you got to play the AI infrastructure, you got to play crypto. Those are the themes that will allow you to stay ahead of inflation these next 5 years.
You got to play stablecoins too. We haven't talked about this, but I want to bring up. So there's this paper. We'll end up here with just some very boring academic. Well, not boring. It was actually, I found it fascinating. But the Bank of International Settlements just released a paper looking at analyzing stablecoins and their impact on basically bond yield suppression. And so I won't go too deep into it, but I'll read the abstract. Tyler, are you making fun of me for bringing up academic?
No, it's like you're this is one of the
It's like I haven't read a paragraph that long
this
in
is
5
this
years.
is how you suppress bond yields, is you got to create a whole new thing to buy the bond. It's
Yeah,
just like,
whatever you do, don't
Okay,
balance
no,
the
but
budget.
here's your acronym. All right. Here's one of the very many acronym factories. This paper examines the impact of dollar-backed stablecoin flows on short-term U.S. Treasury yields using daily data from 21 to 2025. Estimates from instrumented local projection regression suggest that a 2 standard deviation inflow into stablecoins lowers the 3-month Treasury yield by 2 to 2.5 basis points within 10 days, with limited to no spillover effects on longer tenors. We also find evidence of asymmetric effects. Stablecoin outflows raise yields by 2 to 3 times as much as inflows lower them. Decomposing the yield impact by issuer shows that Tether has the largest contribution, followed by Circle, consistent with their relative size. Our results highlight stablecoins' growing footprint in safe asset markets with implications for monetary policy transmission, stablecoin reserve transparency, and financial stability. Boom. There's your buyer of T-bills. It's coming.
It's coming.
So
yeah,
just throwing that out. That's the other acronym.
they think they're being all sneaky, these boomers.
I think stablecoins are going to also become like one of the biggest buyers of this US debt as we all shift to the short end of the curve, and we're seeing other countries do that too. You can see, so like in 2024, stablecoins were like the 3rd fastest growing marginal buyers of US debt. And yeah, man, it's changing quick. It's really interesting. And then you see just how excited the Treasury is. They're all on board. Really, the only thing holding this back is like some Democrats in Congress that just feel like turning this into a fight, which is really unfortunate.
I think it's kind of wild to me how quickly all this is coming together on the stablecoin front, because it really is. Obviously there's a lot of unanswered questions, like in terms of you need integrations into daily life and all these other things, but it's clear it's going to be a big method, and it's pretty sweet to be watching it actually finally come to fruition after years of using them.
What's kind of wild to think about in the future is you're going to have like, your USDC or whatever in your bank account next to all your financial holdings. Like it should all just be aggregated. If you tokenize like stocks and tokenize any asset, it should just be aggregated under one roof when you think about it. And then everyone can kind of transact through those wallets you own. It's kind of a wild, thought experiment.
Yeah, I think we're heading in that direction. I mean, yeah, the biggest hamper has just been lack of regulatory clarity, but hopefully that changes this year because it needs to be where it's headed.
Yep.
Cool, guys. Well, I think we'll end it there. Great one as always. Always good to catch up. Crack some jokes.
Have a good weekend, boys.
Yeah, take care.
See you, fellas.